One interesting outcome of this budget has been that all the tax slabs have been reduced in the new regime, and this has reduced the gap between the long-term capital gains tax rate, which was actually increased in the last budget from 10 to 12.5%, and what is called the normal rate of tax, the tax that applies to your salary, that applies to your FD income, that applies to debt mutual funds if you redeem them, the tax that applies to bond interest, all of that falls into what is called slab rate, and that tax has come down even as long-term capital gains tax has gone up. So we did an interesting calculation. If you get up to 24 lakhs of slab rate income, and remember the way that slabs work is that the first 4 lakhs are not taxed, 4 to 8 lakhs are taxed at 5%, 8 to 12 at 10%, 12 to 16 at 15%, and so on. So if you have up to 24 lakhs of income, then your effective tax rate because of all of these slabs actually comes to 3 lakhs or 12.5%, which very interestingly is the same as the long-term capital gains tax on stocks, for example, or equity mutual funds. So this big tax benefit that was there on investing in the stock market or in equity mutual funds is to a large extent reduced or gone away. And we are not even talking about the standard deduction here that applies if you have income up to 12 lakhs. That is a different story. If you have income which is below that, then the slab rates look even more attractive. But even without the rebate, this and this has been strongly equalized. So who does this matter to? A lot of people in India have something called financial independence at the back of their mind. How much passive income do I need in order to survive? And passive income usually has been taken through capital gains by investing in stocks or equity mutual funds. People do SWPs or systematic withdrawal plans from them, and they are considered tax efficient because long-term capital gains tax, as I mentioned, is 12.5%. But now you can also structure your passive income through a simple bank FD or bond interest or debt mutual funds and still pay quite a low rate of tax without taking any special risk or efforts into equity. Now that doesn't mean that you should not invest in equity mutual funds because equity over the long term tends to beat bonds, it tends to beat debt. The return itself does better, but certainly the tax arbitrage between the two has been greatly reduced. If you factor in the standard deduction of 1.25 lakhs on equity, then this 12.5 improves slightly to 11.85, but again the two numbers, as you see, are very close to each other.